Hello and welcome to our 2025 TMT M&A and Investment Outlook. My name is Sean Murphy. I'm a corporate partner in our London office and I lead our technology practice in EMEA. There was a lot of optimism at the beginning of this year that we would see a very strong rebound in technology M&A and investments. Unfortunately, reality didn't quite live up to expectations. Continued geopolitical and macroeconomic uncertainty meant that the market was more subdued than many had been hoping for. Indeed, global TMT deal volumes decreased in the first half of 2025. Interestingly though, global TMT deal values increased during that period. This meant that we saw fewer but higher value deals in the first half of this year. As we're just past the midway point of the year, we thought this would be a good time to stop and reflect on what's already happened this year and what we're likely to see for the remainder of the year. I'll be discussing this with a range of colleagues from across Europe and the United States. And we're going to be discussing what we've seen so far in 2025, what we can expect in terms of TMT, M&A and investment for the remainder of this year and then also into 2026. I'll turn first to Nils Ralph. Nils is a corporate partner in our Frankfurt office. Nils, could you give us your perspective on TMT, M&A and investment trends in Europe so far this year and what the outlook is like for the remainder of this year and into 2026?
Thank you, Sean. As you pointed out, everybody had high hopes for 2025, but these were not playing out that way. 2025 has been a slower year than everybody expected, and the deal volume has been higher, but the number of deals have been clearly lower than expected. However, among the different sectors in the M&A space in Europe, TMT was one of the more active sectors, and AI has been a key driver in M&A activity in the TMT space in Europe, and acquirers were looking to acquire additional AI expertise or next generation software and IP. Aside from AI, the PE sector, PE investors have been active as well, with a particular focus on software and infrastructure, with a particular interest in acquiring data centers and fiber networks, as well as B2B software providers. The overall constraint obviously has been the tariff dispute between the EU and the US, but I think we can hope now that this has been at least settled to a certain degree, and there's some clarity on the tariff regime going forward for the rest of 2025 and into 2026, as uncertainty always kills M&A activity. For an outlook for the rest of 2025 and into 2026, I think AI will continue to be one of the key drivers in the TMT space. But aside from AI, the defense tech sector has been already picking up a bit against the backdrop of the war in Ukraine. And we have seen a flurry of M&A deals, especially in Germany in the traditional defense sector, but also very large financing rounds for German defense tech companies, which have reached valuations that are similar to those that can be achieved in the US in the defense tech sector. And that's something that will clearly continue over the next 12 to 18 months.
Thank you, Nils. We're now going to switch gear and we're going to talk about regulation and how it's impacting M&A and investment in the TMT sector. For this, I'm going to turn first to Caroline Thomas, who is a partner based in our London office. Caroline is the head of our antitrust and competition team in the UK. Caroline, regulation has become an increasing factor in TMT, M&A and investment over the last few years. Could you share your observations on how regulatory trends in the UK and the EU have impacted and are going to continue to impact M&A and investment in the TMT sector?
Thanks very much, Sean. So I am going to talk a little bit about merger control in the UK and EU, and particularly focus on what's been happening recently and some changes that are coming up. And then I'm going to wrap up with a few comments on the national security regime in the UK and some changes we're expecting there. So in terms of merger control in the UK, we're actually seeing quite a significant shift in how the Competition and Markets Authority approaches mergers. And this follows the government giving the CMA a clear strategic steer earlier this year that they want the CMA to focus on driving growth in the UK economy. As a result, the CMA have come up with a new framework for delivering their work, which they refer to as their 4 Ps. Now, I will probably forget at least one of them when I try and go through the list, but the 4 Ps are pace, predictability, proportionality, and process. And the CMA has taken quite specific actions under each of these headings. So, for example, in terms of pace, the CMA has a statutory deadline for a phase 1 review of a merger of 40 working days, and their internal KPI is that they try and review a merger at phase 1 in 35 working days. So they try and come in just within their statutory target. Under the new approach, they're looking to reduce that and to get through a phase 1 merger review in 25 working days. So this could have a material impact on deal timelines, with that formal phase 1 review potentially reduced from 7 to 8 weeks down to around 5 weeks. And we're actually starting to see this take effect in practice, with some recent phase 1 decisions indeed around that 5-week mark. Another change which is likely to be interesting for the tech sector in particular is the CMA's approach to jurisdiction. As the CMA themselves say, they have an unusually broad jurisdiction by international standards, and this can create uncertainty about which deals are subject to review in the UK. They've just finished a consultation on clarifying how the CMA applies its jurisdictional tests, with a view to improvements on the second of their 4 Ps, predictability, particularly as regards which deals are going to be called in for review. And the government is also considering legislative proposals to tighten these tests. This will be of particular interest to companies that are considering acquisitions in or that might affect the UK, and more predictability will be helpful in terms of deal planning and understanding which regimes are likely to apply. In terms of the EU, one of the big developments to watch out for is the ongoing review of the European Commission's merger guidelines. So these guidelines have been in place for decades, and they set out how the Commission actually reviews mergers for competition issues, including the sorts of issues that are likely to be of concern, and how the Commission will go about assessing those concerns. This review is particularly interesting because it signals an intention by the Commission to get to grips with the way the world is changing. Even just looking at the list of areas the Commission has identified for in-depth focus indicates this. So we have our classic merger control issues like assessing market power, but there are also some much more forward-looking issues such as innovation and other dynamic elements in merger control, sustainability and clean technologies, and digitalisation. It will be really interesting to see what guidance comes out of this extensive review and the way the Commission's thinking has developed in these areas. And where companies are considering acquisitions in the tech sector, this new guidance will be really helpful in terms of understanding where and to what extent the Commission might have issues with the deal. Finally, a wrap-up comment on the UK national security regime, which has had a significant impact since it came in a few years ago. By way of illustration, in the year to the end of March 2025, there were 1,143 notifications under this regime, which is a huge number, and this was up more than 25% on the previous year. So while the vast majority of these transactions were cleared with no issues, it still represents an important deal planning point, because once deals are caught by the regime, they must be notified and approved before they can close. At the moment, the government is working on changes to this system. Some of them are quite technical, for example, exemptions for certain types of internal reorganisation. But there are also changes proposed to some of the specialist sectors which are at the heart of the regime. And these will be of particular interest to companies operating in the tech sector. The way the regime works is that where you have an acquisition of a minority or majority shareholding in a business which operates in one of these qualifying specialist sectors, then the deal falls to be notified under this national security regime. And the changes that the government is considering includes new sectors for semiconductors and critical materials, and also updates to existing sectors including advanced materials, AI, data infrastructure, and synthetic biology. Within those sectors, deals can, if they meet the thresholds and the criteria set out in the government's guidance, need to be reviewed for clearance in advance of closing. And so any changes to that guidance and the exact definitions within those sectors could have quite a material impact on tech companies considering acquisitions which might touch one of those sectors. So something to watch out for later on in the year, but all in all, quite a lot going on in the merger control space at the moment, affecting the tech sector, and lots of change coming over the coming months. Thanks very much. Back to you, Sean.
Thank you, Caroline. Hopefully this has been a helpful update on TMT, M&A and investment trends and activity. In the meantime, thank you very much for joining us.